Thanks for joining us on lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get you the headlines. Indian equity benchmarks trade within a tight range. Oil marketing companies gain between 3 and 5% each.
Kotak Mahindra Bank drops after 3% stake in the lender changes hands in 6 block deals. Sources tell Bloomberg Quint that ING Group is the seller.
Lower than expected headline inflation and signs of slowing growth prompted 4 members of the Monetary Policy Committee to vote for an interest rate cut.
And the Employee Provident Fund Organization has hiked interest rates by 10 basis points to 8.65%. The move will benefit 6 crore subscribers.
All right, let's start with checking in on the markets. Yatin is here with us as always. Afternoon.
Good afternoon, Ira. And the market is very quiet in trade today. In fact, we are just 10, 11 points lower in trade today. What's dragging the index down at this point in time is Big Boy Reliance Industries. That stock is down 1.5%. So some selling pressure seen there. Not only that, Kotak Mahindra Bank, after the block deal, has seen some pressure on the stock price. Almost 3.5–4% down for that one. Remember, there was a big block deal which we'll talk about later. But post that, we have seen some pressure coming in for that counter. HDFC Bank and ITC also are the heavyweights which are dragging the index lower. What is moving well in trade today is the oil marketing pack. So we have HPCL, Oil India, IOC, HPCL, all of these stocks moving in trade. Not only that, Yes Bank, Indiabulls Housing Finance and Vedanta, these are the few stocks which are showing some good momentum, both in the cash markets as well as in the future markets from the volumes perspective. Also, what's active is the select stocks in the ADAG pack. So we have Reliance Communications, Reliance Nippon Asset Management Company, and stocks like Suzlon, which are doing well in trade. Suzlon, as we speak, is at the highest point of day, up nearly 22.5%.
Listen, thank you for that. A moderation in growth and a mandate to target headline inflation was reason enough for 4 out of 6 Monetary Policy Committee members to advocate a rate cut. The minutes of the February MPC meeting show that the other 2 members are still concerned about core inflation. Remember, it was also the first policy under Governor Shaktikanta Das. So how should we be reading these minutes of the last policy meeting? Shogato Bhattacharya, Chief Economist at Axis Bank, joins us on the phone line. Shogato, thank you so much for joining us indeed. What have you made of the minutes and particularly of those who've shifted stance?
Well, yes, definitely. Reading the statements of all the members, the MPC members, obviously, particularly the people who voted for a cut at this point in time, seem to suggest that growth had become an overriding concern. And this is something that Governor had indicated even in his post-policy statement, that given the fact that inflation looks to be sustained at a low level, time to act decisively to stimulate growth. So that's pretty much the summation of what the members talked about. And the fact that all the members uniformly deemed that growth was slowing down sufficiently enough to at least warrant a change in stance. So now the question, of course, is how much is there a real growth slowdown, or is it just a matter of sentiment? More than a growth slowdown, and what are the risks which lie ahead in terms of a quick revival of growth?
Which is precisely my question, Shogato. I was surprised to see the number of times that this reference to slower growth was made, at least in the data available to us so far. We haven't seen a dramatic slowdown or an unanticipated slowdown. And the global growth concerns that have been flagged off by at least a couple of members, what is going to be the impact of that on domestic growth? Should we expect to see it, for instance, in the Q3 numbers or the Q4 numbers?
So, a couple of points on what you talked about, Ira. So one thing is global growth is, particularly in Europe and probably even in China, although not probably as evidently in the US at this point in time, global growth is slowing down. The PMI numbers, the Germany's car sales, the trade wars, the fears on Brexit, other problems in Europe, definitely. But on the whole, I think a global growth slowdown is probably, as has been mentioned also in the minutes, a global growth slowdown is on the net a beneficial to India, particularly through the channels of crude, which is likely to be relatively moderate. So that's one. The second point that you mentioned is what are the signals of this growth slowdown? So till now we have seen signs. some consumer durables, I mean, two-wheelers, passenger vehicles, etc., having slowed down. Probably credit flows also having come down a little bit, although we haven't seen the formal numbers yet in the growth slowdown. And particularly fears of this credit squeeze causing a further slowdown, if not in Q3 numbers, in Q4 and beyond. So those are issues, but my sense, as you mentioned, I think this is more to do with the sentiment rather than actual numbers. But you never know because the numbers are backward-looking, mostly Q3 numbers. What portends ahead for Q4 is something that we need to understand better.
So, Saugata, what would the inference that you'd be making from what we've seen in the MPC minutes? I mean, particularly with respect to rate action, is this going to be? Was this a one-and-done policy, or is this going to be a beginning of a prolonged rate-cutting cycle?
No, so I mean it's not a one-and-done. Most certainly not. And our own forecast, inflation forecast, and we have been wrong before on this. So our own inflation forecast, the average for FY20 next year, that is to say, is currently at 3.4%, the CPI headline inflation, which is relatively very, very low. So even if there are upside risks, oil goes up to 70, whatever else happens, corporate pricing power comes back. So it's difficult to see that inflation will cross 4% in any sustained manner. So if that actually is also seen by the MPC going forward, there is plenty of room for cutting rates. I mean, we definitely expect another rate cut in April. Beyond that, I'm not very sure because there are so many sources of uncertainty that will come in with the rains, with the elections coming in, how much they can pull in. But if the growth numbers, I mean, if we are still growing at about 7.2%, or maybe even less, and if inflation continues in this low trajectory that we have seen, then my sense is that, I mean, there is space for a deeper rate cut. I mean, we are factoring in, as of now, 50 with including the 25 that we have already seen. But maybe, I mean, if this growth inflation trajectory continues in the way that we now see, I'm sure, I mean, given the high real interest rates that exist now, rates can easily be cut in another 50 basis points.
Another 50 basis points. On the flip side, Saugata, I mean, if you look at, I think Viral Acharya sort of alluded to it. He didn't use the terminology as to, what is an appropriate neutral rate for the economy. He talked about the fact that maybe 6.5 is a medium-term, rate that would work in the current growth inflation dynamic. But you're saying that that's not the case. Lower rates would be justified even if we're looking to maintain and contain not just inflation, but inflation expectations around 4% in the medium term.
I would think so, because, it's really, really difficult to take a call on what a neutral rate is, because that would depend on your potential growth, where we are relative to potential growth, how the potential with coming in with capacity utilization increases, inching towards growth, actually inching towards the potential growth. How much of corporate pricing power comes in, that would impact core inflation, together with the other risks in the system on food and fuel that begins to take headline inflation up. So any of these can happen. But to my mind, as of now, the chances of that, all of those factors coming in together are relatively, I think, a tail risk. Of course, I mean, these might be the last silly words that I've said. But I think as of this point in time, a 6.5%, which is essentially 2.5 percentage points higher than the expected inflation rate, maybe even higher. So that seems to be a little too high given our current understanding of growth conditions.
Okay. Saugata, I have one last question, a specific one. Sorry to put you on the spot, but I think, everyone was waiting to understand how Michael Patra explains his change of stance. He's been seen as one of the most hawkish members. I was very intrigued by his statement that it is prudent to preserve sufficient policy space to insulate the economy from adverse external shocks and boost the domestic economy in an opportune manner rather than deplete it in haste. What did you read into that statement, Saugata?
So one, of course, I mean, it's great English. That's one. Secondly, I think the argument that you've also heard before, that maybe you want to lower rates now so that when and if a problem strikes or is the need to hike rates, you can actually hike rates going forward so that you have that space built into this. So that I presume is where he's coming in from.
All right, Shagata. Thanks so much. Appreciate you taking the time to help us analyze
my pleasure.
these MPC minutes. Thanks so much.
All right, let's talk about Kotak Mahindra Bank now. It dropped as much as 5% after the 3% stake in the company changed hands in multiple block deals today. Yatin is here to take us through what really is going on and who's been selling.
Harsha, yesterday we reported that Kotak bank would see a block deal in which ING is all likely to sell most of its stake. However, if you look at yesterday's mandate copy, which we reviewed, had the intention of ING Bank to sell close to 1.21% stake, which was nearly 3 odd crore shares. Now, in the morning, what we have seen is that the total quantum of the block deal was nearly 3% of equity and over 7 crore shares traded in the price band of 1325 to 1335. So that was the broad range in which various block deals happened. What we are gathering from reliable sources which were handling the transaction is that ING has sold its entire stake in this block deal, given the fact that there was decent amount of appetite for Kotak Mahindra's paper, and more importantly, a lot of investor interest was seen as far as this block deal was concerned. As of 31st March, which is basically second quarter end, we saw ING holding nearly 3.06% stake, and it seems like given the quantum of the block deal which happened in trade today, ING would have sold its entire stake in Kotak Mahindra Bank, which they got in lieu of ING Vysya Bank's merger, which happened in 2016.
Thanks so much for that, Yatin. The bank-led resolution plan approved by Jet Airways board has left minority shareholders an unhappy lot. They were hoping to get more clarity at the extraordinary general meeting, which was held yesterday, but at the end of it, they were left with more questions than answers. Ridhima Saxena caught up with some of them to understand their grievances.
Why the government of India is trying to salvage this company, why State Bank of India is sinking in, risking the public money in trying to revive the company, which is a flying NPA, which is virtually dead. There is no potential to recover, yet they are trying to see if it revives and flies. The issue is what is going to be the new pattern of the equity or the management is all unknown. But one thing is very certain, that in any case, the interest of the small shareholder is at grave risk. But only in this case, for the first time, this bank is not taking them to IBC. They are trying to come forward and resolve the problem at their own end by restructuring the debt, by taking a huge haircut. At 1 rupee, even if they are able to take whatever share they want, I mean, it's whose loss? It's public loss. It's the banker's loss. And I simply say a banker is a banker and must remain a banker. Banker here is trying to become an investor. The natural process should have been that the company should have gone to IBC and a potential investor or promoter should have come, valued a company afresh, and then there would have been a revival plan. That is what is acceptable in the market-driven economy. I don't want anymore the government to become a regulator or the owner. We have enough of the companies owned by the government and they've all been ruined. So why are you repeating the whole experiment again?
I am not comfortable with whatever the meeting is held today, because the management team, they suppressed some matters. They are not ready to disclose what is the problem affecting the Jet Airways and how to solve the problem. God forgive, Jet Airways should not close down, because it is question of millions of not millions, maybe say thousands of employees and the stakeholders.
He should be there at the meeting to restore confidence with the shareholders, to explain what situation, what step he has taken, because still it wasn't clear like why, what's going on behind the scenes, like who will be the exact owners. So next time in AGM, if he comes and attend and speak, so it will be good, for people like us, for the his employees, because I believe he don't stay in India. He lives in Dubai or London. So I hope he comes to India and say something which will restore confidence. We are just expecting something positive, and this will take time. It won't happen in months. This will take time, and of course, now there should be calling in the like if suppose banks, when they take over the management, that will be a disaster. I think so it should be run by the experts with the backing of banks. I don't think banks should be interfering in the management of the aviation. Do this and do that, because unfortunately in our aviation we have a lot of opportunities, but at the same time there's a lot of chaos also, because now airline like they are not a single same page. They work on their own terms. So I hope things get better.
View from shareholders. Remember, Jet Airways had called the EGM to get consent for the lenders to appoint company directors and increase share capital, all of which in turn would enable Jet to execute the bank-led resolution plan. While all resolutions were approved by shareholders present at the meeting, we're still waiting for the final tally that will be available only after the electronic voting numbers are factored in.
6 crore subscribers who invest in the Employee Provident Fund will get higher returns for the soon-to-end financial year. The EPFO board has decided to hike interest rates after 2 years of cuts. Nikunjori reports.
The EPFO has finalized its interest rate for financial year 2018 and 19 to 8.65%, which is an increase of 10 basis points from the previous financial year. The move will benefit about 6 crore EPF subscribers, and the decision on the same was taken in a meeting of Central Board of Trustees of EPFO, which is headed by or chaired by Union Labour Minister Mr. Santosh Gangwar. The proposal will now have to go to the Finance Ministry for its final approval. The increase in interest rate will leave the fund with a surplus of 151 crore rupees as against an excess or surplus of 586 crore rupees the previous year. Remember, EPFO had a total corpus of 13.33 lakh crore rupees as on March 31st, 2018.
Thanks, Nikunj, for that. Systematic investment plans, or SIPs, may be falling out of favor among retail investors in India. AMFI data suggests that mutual fund, the new SIP registrations have fallen significantly over the past few months. Neeraj is here with a snapshot of what that data reveals. Neeraj.
Thanks, Asha. Well, some data borrowed from a couple of sites, some data calculated ourselves, but it's data which is showing some interesting trends nevertheless. Let's just pull up those numbers. Firstly, this is as per, of course, Cafe Mutual, which they say they have sourced it from AMFI. The blue bars are the new SIP registrations, and the yellow bars are the SIPs which have been discontinued. Now, as you see, or rather, if you will see, in April, we had a number which wasn't the highest, but then for the next 5 months, we've had a number which is over 10 lakh accounts getting registered every single month. That came off or started coming off in October. Again, not an alarm bell, but November and December were pretty steep, and the December number at 7.23 is particularly interesting for one more reason, and the other reason is the SIP is discontinued. Now again, on months when we had a higher SIP registration and SIP discontinuation wouldn't raise too much of an alarm bell, but in the month of December, the SIPs discontinued rose to 5.36. The SIPs which were new registrations came off to 7.23, and therefore the net number was a very contracted number, which is the bit of a double whammy that people are talking about. Again, the live SIPs coming off quite rapidly. The outstanding accounts will naturally show an uptick because the actual number is still getting added, but the pace of addition is a lot lower. Now, there are a couple of reasons when in conversations with people and just thinking out about what could have led to this, and I saw two principal reasons why this could have happened. One, from October onwards, that Aadhaar-based KYC process was changed to a full KYC. Now, this would probably hurt insurance players and mutual fund players both. I don't have data about what's happened to insurance schemes per se, but AMCs have certainly seen a part of this. We were speaking to a couple of AMCs, and you'll hear them as well, but they themselves mentioned that even in their direct accounts, there was a drop that came in from the direct subscribers. The bottom layer, which could invest up to 50,000 per AMC by the minimum KYC norms until October, they've all gone off. And therefore, that number would definitely take a hit. And the market volatility, I mean, the last 12 months, if we look at the XIRR returns for some of the SIP investments, a clutch of names have delivered numbers on the negative side in excess of 20%. Now, that's not something that, first-time investors or even actually regular investors who've come in would love to see. So that could be one more reason as well. And keep in mind, the only thing that I think a lot of people say is that we got to keep in mind that SIP flows are a very healthy number. So in June 2017, the inflow in rupees crore was about 4,744 crores. That number has gone up to 8,000 crores. Even the preceding one was about 8,000 crores. So if this number comes down to 7.5, it's not alarm bells. But the question mark that everybody would be asking is, could this be a start of a trend? And that is something that would worry AMC CEOs. Some fund managers are actually happy because lesser money coming in, which means they can invest better. And a couple of fund managers have been on record saying that we are happy that the drove of money that was coming in has slowed down. But this is something that should worry. I'll just leave you with one key data point though. And again, debatable because data can hide more than it reveals. But here's the data. These are XIR returns, which is for an SIP. The 3 worst performing SIPs in 2018, Sundaram Small Cap, DSP Small Cap, Aditya Birla Pure Value Fund. The returns have been abysmal. But if you extend the time periods, the numbers have been pretty good for these. The only point that I'm trying to make is if you keep this number in mind, which is DSP Small Cap, after the 21% drop in 2018, over a 10-year period, the XIR returns are still about 19.57. Compare that to the return, 10-year returns of the 3 best performing SIPs in 2018, which is Axis Long Term, Axis Blue Chip and UTI Equity. None of them have delivered those numbers as well. So 2018, a very bad year, need not mean that these schemes will continue performing poorly. That is that one thing that people should keep in mind. Back to you.
All right, thanks so much for that, Neeraj. In fact, Neeraj caught up with Radhika Gupta of Edelweiss Mutual Fund and Kanpen Parekh of DSP Investment Managers earlier today. Listen into what they had to say on this issue.
There are 3 reasons why systematic investment plan numbers have dipped off a little bit. One is, I think, more business as usual, and 2 are, a little bit of what's happened in the last few months. One is, of course, systematic investment plans grew very popular and a lot of investors entered over the last 1.5 years. Now, because equity market performance has been relatively patchy, especially in the mid and small cap segment, and a lot of SIPs do happen in mid cap funds or, multi-cap funds, people are seeing 1-year negative returns on systematic investment plans. So for first time investors, that makes them a little bit jittery, and hence you don't have as many new investors coming into systematic investment plans. You have a couple of people also potentially withdrawing. So that's something that is expected in these kind of market conditions, although it's not something one recommends or it's not something that is ideal, but it is something that can happen. 2 other things have also, of course, happened, frankly, over the last 6 months. And one is a change in incentive structure for distributors selling systematic investment plans. That would have had some impact, and that's something we can't take away from. And then the second, to a smaller extent, is the impact of not allowing Aadhaar to be used as a form of KYC. So that will impact some of the online players. So 2 of these things are a little bit driven by regulatory changes, and I think they were expected. The first is, of course, market conditions, but that I think will normalize with markets getting a little bit better.
I think Radhika's first point, Kalpen, about the KYC norms change and the impact that it has on online players. Now, I was speaking to a couple of online brokers, and without giving me numbers, which they wouldn't, they did say that they are facing some dip in the online registrations. The mass market, the bottom end of the market, which was getting in at 50,000 rupees without minimum KYC, is now facing issues. Have you heard of the same? Are you facing that in your direct subscriptions as well? And is this something that will change? People get attuned to a new norm, and at some point of time, they'll come back to a good product.
Yeah, I think the product universally has been good for decades. It got relevance in the last few years because everyone started speaking about it. And it became a part of even analyst reports, making a case that why the India equity story will have more depth, because there is a block of $1 billion coming in every month, which is counterbalancing FII. So SIPs never got this type of recognition in narratives till now. These dips are seasonal, and the 2 seasonalities are, one is regulation and primarily the operational inconvenience now with Aadhaar not being allowed. So that is the reason why the dip has happened for digital players, our online subscriptions across the industry, as well as the fundamental reality that human beings like last 1 or 2 year returns to look good for making future investments. Having said that, you asked a question that is it something to worry? And for an investor who has started his SIPs just 1 or 2 years back, and 90% of investors have done that because this cycle has started only 2 years back. And when they started off, they've contracted for 10, 15, 20 year SIPs. There is a 25% block of SIPs, which is a perpetual SIP, which means it can last for longer. So operationally, people have signed up for 10, 15 and 20 years. But behaviorally, people have committed only till the time returns look good.
Sure.
And the fundamental point, I think, and I'm glad that you're doing a show at this point in time to help investors appreciate. I was doing this analysis for our small cap fund, which is popular for SIPs, but also has been volatile in line with all small cap funds. In the last year, 2017, when markets were going up and NAVs were going up, an investor on an average was getting around 75 units per month. Today, he's getting 93 units per month. So there is an uptick of 22% extra units that an investor is acquiring. So from an investor's perspective, who have started off their SIPs and who still have a 5-10 year increment, which means 60 more installments to acquire, this is a great time. In fact, they should celebrate these moments and take advantage of this.
All right, let's move on. Boeing Defense Systems is willing to set up a production line to build F-18s in India if it manages to bag order from the Indian Air Force and Navy, that is. The fighter jet manufacturer acknowledges that there are at least 7 competitors eyeing the same orders, but says that its agreement with HAL and Mahindra gives it a head start over the others. Nishant Sharma spoke to Thomas Breckenridge, the Vice President of Sales at the Aero Show in Bengaluru. Here's a slice of that conversation.
There's a lot of things that I think distinguish what we're bringing to India versus what our competitors are doing. And one of the most important things is that the F-18 has an entirely new and transformative set of capabilities that we call Block 3. And it includes things that bring extended range, additional lethality, more stealth, new computing power, a longer life for the airframe. So there's a lot of new capabilities in the aircraft itself. The second thing is that with Boeing and the scale that we can bring and the commitment that we can bring to the market, we have a really compelling Make in India story that we can share here in India. And we're very proud to be partnered with HAL and Mahindra on the fighter activity here in India. And with our partners, we fully intend to bring a factory of the future. This is not a transfer of an old factory or old production line, but this is a brand new factory here in India producing one of the world's most advanced fighters out there. And then the third thing I'd just point out is that there's significant cost advantages with F-18. It's actually the lowest fighter to operate in U.S. inventory, and with the cost advantage, that's a pretty compelling piece of the story as well.
From that, you'll be able to crack the deal in this market, because it's crowded with 7 players already eyeing for the pie of 114 jets.
Well, first, I'd just point out there are 2 competitions. There's a competition at the Indian Navy. There's a competition at the Indian Air Force. We're interested in competing in both, and that, I think, positions us pretty uniquely in the market. And I think the other thing is, really importantly, looking at Boeing in India, Boeing's unique in the sense that we've been here for 7 decades, more than 7 decades. And in the last 10 years, we've been investing a significant amount of resources, building an ecosystem around our products and integrating into the industrial base of India. So all that's to say, we've been here for a long time and we're committed for the long term in India. And I think that really distinguishes us from others. We are truly committed to a long-term partnership here, and we recognize that to be able to effectively produce an advanced fighter like the F-18 in India, it's not something you can flip a switch and do overnight. It takes a long time and it takes a real commitment. And I think that distinguishes Boeing from any other company out there.
And as per the contract by the Indian government, it should be majority owned by the Indian partner. Does that put you at a disadvantage? Do you want to have a controlling stake?
Well, I don't want to get into the specifics of our agreement with our partners, but I can say that we're very confident and comfortable working with HAL and Mahindra, and we believe that the partnership that we're forming will not only meet the spirit and intent of what the government of India is working toward with their Make in India initiative, but will also be something that really helps us as we build our presence here.
What would you prefer, to have a controlling state or let an Indian strategic partner have that?
We're comfortable with the nature of the rules here, and from what we've understood coming from the government, we're very comfortable, and I think have shown a track record to be able to work within the rules and the regulations that have been put forth so far.
BEML has come a long way from making heavy earth-moving machinery to metro coaches. It also recently bagged an order to build engines for the Arjun tanks used by the army. The new frontier for the state-run company is aviation. Sajit Mangat caught up with BEML's chairman and managing director Deepak Kumar Hooda and started by asking him how much aerospace currently contributes to the company's revenue.
At the moment, I would say our aerospace is contributing about 50 to 60 crores, which is pretty small. But I think this will grow substantially.
You're telling us that trying to bring in the civilian version of this this Sukhoi or the trainer aircraft, and that will help in increasing number of training for pilots and other stuff. You have already inked the agreement for that?
Well, we just are in the process of NDA with Irkut, and then we are going to look at the market space. We will do a benchmarking. We will look at the costing. They will come and look at our facilities. We will go and see what is it that they are offering us. This is just the beginning of the big journey that we have decided to undertake with them.
And aerostructures will become a bigger pie for you over a period of time. What kind of investments are you looking at into that aerostructure?
See, I don't want to give you numbers of investment, but just to say...
Just to get an idea of...
Yeah. Like 2 days back, I heard the Civil Aviation Secretary mentioning that today we have roughly about 600 to 700 civilian aircrafts. This is going to increase by another 1,600 in the next 5 years. The government is also insisting, and rightly so, that the MRO, maintenance repair overall of these aircrafts, should be done in India. It should not, fly out and then be done there. So when that happens, can you imagine the kind of opportunities that are going to come? Huge, the way the metro is growing. Plus, you also have a huge shortage of pilots. So the civilian aircraft, the trainer aircraft that I spoke to you about with Irkut, that will fill that space.
From a tank perspective on the land systems front, you've been a pioneer in that because the Arjun was prototyped by you. Where are we on that land systems? Have you been able to bring in other prototypes into the market, and are you looking to bid for the government's new program to the strategic partnership?
Yeah, I think, we have made the main battle tank 1 prototype. It was trial evaluated, but today the main battle tank overhaul, they want to give it to us. As you would know, the design for all this is essentially DRDO design.
Yes.
Incidentally, we have recently got an award, or rather an order, for developing the 1500 horsepower engine for the main battle tank. This is a very, very prestigious order for us. So this is going to power the new battle tank. So we are there. As I said, the armored recovery vehicles, we are already there.
Yeah.
We had supplied 350 odd. We will be supplying another 200 odd. So that is a space that we are in. And, all the heavy duty vehicles, missile components. We also make the dozers, which is used by the army in the border areas to clear the roads, clear the snow. So that's also, something that we do. So net, I would say that there is a shift from land system to, things like drone, missiles. So we are preparing ourselves to take advantage of that.
And you are getting into drones as well in a big way?
Not at the moment. We are examining it. I mean, end of the day...
There's a drone policy which has now come out. That was mostly for civilian. But from a military point of view, are you looking at, trial and doing R&D on that front?
See, we have a very big R&D and we have a great capacity to absorb technology. Having said that, you may want to look at various parts of the market which is growing, but we also have to see our management bandwidth. And as you would know that BEML already is involved in too many areas. So drone, yes, it's interesting, but there's nothing specific at the moment that we have in that.
Out of time on the show. Thank you so much for joining us today.
Lots more coming up.